Okay, thanks, Rodney, and good day to everybody. Obviously, for people who've followed us for a while, we are starting to see a once-in-a-lifetime event, something we've been forecasting now for 20 years, since the late 80s, early 90s. We've said, this baby boom-driven incredible boom and bubble boom would come to an end around the end of this decade, and we would enter the next Great Depression. In fact, we said, I think it was on page 16 of the Great Boom Ahead way back in 1992, this would occur between 2008 and 2023. So we are starting to go through a long downturn, a deflationary or a deleveraging of the credit system and all the bubbles we've had, much like Japan went through in the 1990s and early 2000s. And, of course, our demographic research in the late 80s forecast that, and people thought that just wasn't possible at the time. So it is important for you as an investor or as a financial advisor and your clients to understand that this is a long-term crisis, and it's not another correction in the markets, it's not another recession, and even this credit meltdown is not the main thing that's going to cause this long-term. A 40-year cycle in generational spending, the greatest one we've seen in history, is peaking, and if you look back in history, we've seen major long-term peaks in the stock markets about every 39 to 40 years, 1929, and again, remember what we've always stressed. Once that peak was made in 29, we did not get back to those levels in the stock market until 1953, 24 years later. The next major peak was 1968 when you adjust for inflation, and we did not get back to those levels until 1993, 25 years later. So we've just seen a peak in late 2007. And it's going to be a long time before stocks get back to that levels. And you've got to remember, for people who understand our demographic research, the echo boom generation just kind of replaces the baby boom over time. It's not a new, larger generation like we've seen for centuries now. So it's more like the United States is going to plateau. And much like Japan, we were saying back a long time ago that the peak in the Nikkei back in early 1990 at near 40,000 was probably a peak for the rest of our lifetimes, and because Japan is slowing down long term. So we kind of call this, to summarize, the perfect storm, peaking of a 40-year generation cycle, and this is unusual, also the peaking we'll show today of a 29 to 30-year commodity cycle. Those two cycles don't normally peak at the same time. This has not happened in the last century. So it makes this scenario even more complex and more tricky, and I think most economists are not going to fully understand what's going on here. And just to give a kind of a parallel analogy to the storm, most people understand hurricanes from all the stuff we've been through in past years. We have seen the first part of the storm hit in 2008. And in 2009, we think we're going to increasingly see the eye come over, where things calm down. We have all this stimulus, a new president, hopes of a recovery, and we're probably going to get a recovery in the second half of this year. And then the second side of the storm, that's going to be the big surprise. The second side of the storm hits stronger than the first, building on the first, from late 2009 into 2010, and then we get massive flooding for 2011 and 12. So that's kind of the overview. This is going to last a long time. We think the Dow is going to go down to something like 3,800, maybe 5,000 at best, back to where this bubble started. We think home prices are going to go back to where that bubble started between 1996 and 2000. So look at your home, and you think it's gone down enough to ask if it's gone down to 2000 or 1996 levels yet, and the truth is it hasn't, so it's got a lot farther to go. So real quickly, let's run through our logic just so we can document this, and of course we go into this in way more in depth in the book from a lot more angles. But again, most people are familiar. We look at generation cycles, the first graph, birth index, or just for immigration, past and future, and we get these generational cycles, and people just grow up and earn and spend more money and become more productive as they age. They peak in their spending around age 46 to 50. They start to peak at 46. There's a plateau into 50, and then they spend less the rest of their life. I mean, this is not a theory. It's a fact. So as new generations, you'll see in the third slide, go up this spending and innovation and productivity wave, our economy expands, and that's why it peaks about every 40 years, 1929, 1968, and here 2007, 8, 9. Now, you'll note here we've had this extreme crash from this credit meltdown, which I'll discuss more. But even without this credit meltdown, this indicator says, like the Japanese in the 90s, the United States and Europe and most major developed countries in the world will see a long slowdown from around 2009 or 10 into the early 2020s with a short reprieve in like 2015, 16, 17, that sort of thing, and then before the next generation comes along. So again, this is a long-term downturn, and this is important because a lot of people are thinking, if the Fed does the right thing, if the government, the Treasury does the right things and stimulates our economy and supports the economy and the banking system, we will turn around and we'll come back to normal. And the answer is no, we won't. They'll be fighting a slowing tide of spending, deleveraging households, and they'll be pushing on a string just like Japan did. Japan had interest rates near zero for the entire 90s, all types of support for spending and infrastructure and the banking system, and Japan continued to go down, so did their markets, et cetera. So long-term downturn. But we also have a commodity, an oil bubble, much like in the late 60s, into the 70s, that we show in the next slide. Oil prices went down to sideways from 40 down to 10 between 1980 and 1998, and now we're in the next bubble, and it is possible this bubble has not peaked. That may sound hard to believe, but it may have peaked at 147. We may just come back up near there again, but it's possible we could see a new high in oil prices. Because back in 2006, when we started to diverge from our stronger forecast for the Dow, we used to be saying the Dow could go to 32,000 plus. We started saying, no, there's a commodity cycle that's working against this, rising oil prices, and we went back in history and found this clock-like 29 to 30 commodity cycle every 29 to 30 years, 1920, and then a double peak you'll see there, 1949 and 1951, so on average a peak there around 1950, and then the next peak 1980, and the next one's really not due on this cycle till around late 2009, early 2010. So again, it's possible we peaked a little early here, but this cycle would say, hey, there could be another run in commodities, and with all the stimulus we're seeing, that makes that more plausible. I want you to also notice here that 1949 and 1951 peak. Note that commodities prices spiked up, crashed, just like they're doing now, and came up one more time. So to a new high, and we're saying that's a possibility here in this scenario.